Well, thanks for having me here. The first slide is about me. I'm an economist. I try to find a joyful picture of me, and there was this app which puts taglines on pictures. So with the joyful face, I would say living la vita loca. And as an economist, as a PhD student, I started being interested in theory first. But as it usually happens nowadays, in my field, economics, people start being interested in theory, but they move slowly toward data analysis. And here is where Python and also other programs like R and Stata come in. My current research focus is on the housing market. And this is what I'm going to talk today. The structure of the talk would be first an introduction, then I will talk about the data that I use in my research, the matching procedure, where I put together different data sets from different sources to get some interesting result out of them. Then some findings, then some more matching, and then the summary and the way forward. I'm not going to talk a lot about specific snippets of code. I will be talking more about the kind of things that can be done with the data on house prices and rents that is currently out there. So if you are from the UK, you already know this. If you are not from the UK, you have to know that this is an house price obsessed country. We talk about house prices every day in every social encounter, and so this talk fits this pattern. So the thing that I wanted to study is the relationship between prices and rents. Also, we can indicate it as the price-rent ratio, as some people measure it, or also, as more people measure it, the ratio between rent and prices, also called the rental yield. And you can immediately see that this measure, for many people, is crucial, because if you are a household and you are deciding whether to buy or to rent your accommodation, then clearly the ratio between prices and rents is very important. But also, if you are a landlord or an investor and you want to know what will be the return of buying a property, then also this measure is crucial. So what is usually done in analysis is to measure this ratio at the aggregate level. So in newspapers, or in magazines like The Economist, we often see a time series of aggregate prices versus aggregate rents. And when prices are high with respect to rents, we think the market is overvalued. When prices are low with respect to rents, we think the market is undervalued. But again, this is only an aggregate measure, and it is a time series measure. What is less known, but is equally important, is that if we go from the time series measure to a cross-sectional way of analyzing these things, we see that not only the rent-price ratio varies over time, but there are very big differences in rent-price ratios across geographical areas. This is taken from the Financial Times. This is London. And as you can see, the rental yields are generally higher in the more peripheral postcodes of London, whereas in the most expensive areas, we have rental yields between 0 and 4%. So prices are very high with respect to rents, or rents are cheap with respect to prices in the more expensive areas. Now, when companies and institutions do analysis like this, they take the average price for, say, two-bedroom properties, and they compare it with the average rent for two-bedroom properties. So it's still an aggregate analysis, and we might think that the average property for sale, two-bedroom property for sale, is different, perhaps it's a higher quality than the average property for rent, the average two-bedroom property for rent. So these measures are fine, but are not perfect. Ideally, we would like to measure the price and the rent on the same exact property, and this is what I do in my research. So why this is the only formula of the talk. Why should rent price ratio be different across different locations, and why should they change over time? Well, in economics, we now have no arbitrage conditions because they tell us it is impossible to make extra profits in the market. So in equilibrium, the rent, the amount of money paid by an individual as rent should be equal to the user cost of owning a property. The user cost is the cost of keeping a property for 1 year, and it depends on the interest rate, the risk, the expected growth, and maintenance. And the reason I'm showing this formula is to say, well, if we see that the rent price ratio changes over time and across space, it must be that it's because these things change. So interest rates change over time. Maintenance cost can be different across different types of properties, and expected growth and risk clearly are different both over time and also across space. So in my analysis, I need two sources of data clearly. One is house prices, the other is private sector rents. Now, house prices is the easy part because we now have the Land Registry price paid data, and it has been released last year, the entire data set, starting 1995 until 2013. This is an incredible, for people studying the housing market, it's an incredibly useful data set. It's 18.5 million records, and with these variables, we have the full address of properties, the price paid, the date the properties were sold, etc. When I started this research, this data was not available. However, at the London School of Economics, we used to buy the Land Registry data set, and we had the data until 2011. And for my research, I really put pressure on the department to buy the data for 2012. As soon as they bought the data, they spent a lot of money. The land price released the data for free 2 weeks later. So now for the next 5 years, I will avoid asking them to buy new data sets. OK, so some insights can already be seen by simply plotting the data. So these are all the sales in London from 2006 to 2012, plotted. I stopped at £1 million. This is just a simple moving average, and the moving average already gives you an idea of where prices are going. This is similar to the price indices we see in the newspapers or in magazines. And some interesting patterns emerge, right? It's very difficult to see transactions around the 1st of January, the 31st of December. So you see we have these white lines here. And also, we have these horizontal white lines corresponding to these very specific prices, 250,000 and 500,000. So why is that? Yeah, exactly. The stamp duty is really, really important to understand the distribution of house prices. The stamp duty jumps, I think, from 3% to 4% at 500,000. So no one sells their house at 501,000 or 505,000. So people are rational in the price they set on the market. Now the problem is data on private rents. Here I'm quoting an official review by the national statistician that was saying a gap exists in official private rental statistics. So if there is something that is missing today for people that are studying the housing market, it's good data on private rents. There is a hope for the future because in 2013, very recently, the Office for National Statistics released an index for private rents, and it's based on valuation office agency data. So this agency employs rental officers that go around the country and ask people how much is the rent. So this potentially could be, in the future, the Land Registry of rents, let's say. But for now, the data is not available, so we have to find different sources. So when this is the case, where you don't have the data, you have to ask. So I asked around, and I find people willing to listen at John D. Wood & Company, which is a private real estate agency. It has offices in London and the countryside. It deals with central southwest London, and it's in general an upper market agency. However, real estate agencies have data on private rents, so that was great for my research. So this is a map of the rents they have in their data set. They only have new contracts, so that potentially is sometimes a problem, not for my research, because clearly they only have data on rental contracts that go through real estate agents. So if you renew your contract, it won't be in the system. They own rental contracts, and also data from other agencies. And you see this is the area of London that they cover. These also are the parks, Hyde Park and Regent Park. And so this is, in this research, the area that I analyze. This is the data on rents, again, just by plotting weekly rents. So you can see this is an expensive area of London, so the average weekly rent is between 400 and 600, and this is sort of an index of what rents are doing in this period. So the matching. So the idea here is to match prices from the Land Registry with rents from this agency and measure the price-rent ratio for individual properties. Now, you probably know this much better than me, so sometimes matching the different data sets is easy, and sometimes it's more difficult. So the Land Registry has this information: postcode, primary addressable object, secondary addressable object, and street. And sometimes these entities correspond perfectly to what is in the agency data. Sometimes it is more complicated. So usually it's easy to match houses. It's much more difficult to match flats, because when you deal with flats, you have the flat number, you have the street number, sometimes you have the building name, and it's not always clear what is what. So in this case, Marsh Court, 561 and 4, it's not immediately clear if 4 is the street number or the flat number, etc. So we have all these problems, and often this data is compiled by agents, so often the variables are in the wrong place. This Rupert House is probably the name of the building, not the address, and so there is some manual work involved in the matching. But once the matching is done, so this is what I just said, what I do is, clearly, since there are repeat sales and repeat rents on the same property, for each sale I keep only the closest rent, and for each rental contract I keep only the closest sale. This is a bar chart of how many days I see in my matched properties between the sale and the first rental contract. So this graph makes sense because conditional on there being a match between a sale and a rental contract, most of the matches are close, which means these are probably buy-to-let properties. They were sold and then they were rented out. We don't have many rental contracts starting just before the house is sold, and this makes sense, because why would you start a rental contract just before you sell the house? So I focus only on these very close matches where I can say that the price and the rent were measured at approximately the same time, so I have a good measure of the ratio between prices and rents. Now, the good thing about private data sets in this case on rentals, but in general, is that we have many more information, many more attributes, housing attributes, with respect to the Land Registry. So when I match with the land registry with my agency dataset, I know the floor level of the property. These are some statistics to compare my complete dataset and the matched dataset. And I also have other variables like number of bedrooms, whether the property belongs to an apartment block, the floor area, whether it's furnished or unfurnished. These things are important when analyzing house prices and house rents. Now, in terms of results, so these dots are my matched properties. So properties where I have price and rent, and on the vertical axis I have the rental yield. So the average rental yield in this part of London has been around 5% between 2006 and 2012, but it has been declining, which means both rents and prices have been going up recently, but prices have been going up more than rents, and therefore the rental yield has been going down. If you remember the formula for the rental yield depends, among other things, on the interest rate. So if you plot one measure of the interest rate, the 10-year UK government bond yield, you see that it has been declining consistently with the decline in housing rental yields. Now, a very important finding is this one. Again, on the vertical axis, I have the rental yield. On the horizontal axis, here I have prices, and here I have rents. So the message of these plots is, in general, more expensive properties have lower rental yields. So when you go from a cheap property to an expensive property, both rents and prices go up, but prices go up more in relative terms than rents. Therefore, the ratio between rents and prices is around 2-3% for properties above, let's say, £1-2 million, so very expensive properties, but it goes up for cheap properties. It starts around 6. You see there is a clear negative relation, and the same goes for rents. Now, because if you compare the ratio between rent and prices with prices, you mechanically have a negative relation, so you might not trust this plot. But if you compare the rent-price ratio with rents, you would expect a positive relation. Instead, the relation is still negative. So this is an important thing, an important stylized fact in the housing market that is not often discussed. Now, if we, on the horizontal axis, instead of price, this pattern is evident both in apartments and houses, and also for big properties and small properties. So the bigger the property, the higher is the price. Of course, the higher is the rent, but the prices go up more than rents. And the same with postcodes. The more expensive the postcode, the lower the rental yield. And these are just bivariate relations. I can run a multivariate regression on all property attributes, and I find the same fact, the same pattern. So in terms of explanation for these patterns, I'll talk about risk and expected return, but one thing that is often, I think, overlooked is the role of maintenance cost, or if maintenance is not paid, depreciation, the price of the property will go down. So why is that in more central, more expensive areas, the rental yield is lower? So you can think of house prices as the sum of two things. One is the price of the land on which the house is built, and the other is the price of the structure. Now, the structure varies little between one location and the other. To build the same house here outside London or in Chelsea will cost, in terms of materials and labor, the cost will be more or less the same. Whereas what really changes is the price of land. But if you think about maintenance and depreciation, these expenses relate to the structure, not to the land. So where inexpensive areas, as a percentage term, maintenance and depreciation are less important than in cheaper areas. And this is an important factor that drives the differences in rental yields. Now, to measure the effect of appreciation and risk on the rental yield, I need to do more matching, this time not between datasets, but within datasets. So there are properties that sell repeatedly and properties that get rented repeatedly. And if I can measure the appreciation between one sale and the next one, between one rent and the next one, I can measure the appreciation for that specific property. And this is important for my research. It turns out that repeat sales are not that easy to find in the data, because the average UK household stays in an owner-occupied property for, I think, 10 years. So with not much of a time window, it's difficult to find repeat sales. But it's much easier once you have rental data to find repeat rents on the same property. And this is very useful to measure how rents appreciate over time. So this was my matched data set where I find a sale and a rental on the same property. So I found 2,000 data points, almost 2,000 data points. Now, within those within that sample, I look for rents on the same property. So I want, for the same property, first a sale, then a rental, and then another rental in the future, so that I can measure the rental yield and also how much rents have grown over time. If the theory is correct, when for properties where growth has been higher in the subsequent years, then the rental yield should have been lower when it was measured. And indeed, I find that future rent appreciation predicts the rental yields. Another thing that I can measure using repeat rents is the volatility of rents. How does, with respect to the same city, let's say London-wide index, how many individual rents go up and down, how unpredictable and volatile they are. Now, theory here is ambiguous because volatile rents, on the one hand, should bring down prices because investors don't like volatility, don't like when something is unpredictable. But on the other hand, if rents are volatile, consumers, households will prefer owning rather than renting, and therefore this could push up prices. And indeed, when I measure the volatility in rent appreciation, I don't find any relation with the rental yield. So to sum up my findings, so this is a way to exploit one data set that is public, that is freely available, the Land Registry, and a private data set on rents to measure rental yields. And I find that rent price ratios, rental yields, are lower for more expensive properties. And this is true both in the sense that bigger properties have lower rent price ratios, but also that properties located in more expensive areas have lower rent price ratios. And this is consistent with economic theory. This is just the beginning of my research agenda. So the Land Registry, the bottom line is, I think the Land Registry is a recent open data resource with a huge potential, and it is a platform, a starting point, and one can merge all sorts of property-based data onto the Land Registry and find important things about the the housing market. This analysis is on central London. The goal is to expand it outside, to expand it to the whole UK. But for doing so, to do that, I need new data sets, and I think I will try to contact websites that have a lot of information on rents and prices and property attributes, and perhaps other agencies. So I think if anyone here in the audience is interested in doing research on house prices, in using the Land Registry, let's just get in touch. And I'm sure there are many, many, many things to be done in this field. Okay, thank you.